Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the corporate world with a little bit of a smirk. Today we are diving into STERIS PLC's latest financial report, a look at their performance in the last quarter of 2025. So what is the story here? STERIS is a big player in infection prevention and healthcare solutions, and their latest filing gives us a peek under the hood. We will be looking at their revenues, their profits, and what all those numbers actually mean for the company. Before we jump in, if you enjoy getting these kinds of insights directly from financial reports, smash that like button and subscribe. Also join our Discord community linked in the description below. We have some great discussions happening there. Let's start with how much money they made their revenues. For the 3 months ending the 31st of December 2025, total revenues were $1.496.2 million. This is up from $1.370.6 million in the same period the year before. That is a pretty solid jump of over 9%. And looking at the longer picture for the first 9 months of the year, revenues grew by a similar 9.3%, reaching $47.5 million. This growth seems to be spread across the board with all three of their main business areas, healthcare applied sterilization technologies, or ASTE, and life sciences contributing. Diving a bit deeper into what is bringing in the cash service revenues saw a nice 10% increase over the quarter. This means the services they offer, like equipment maintenance and repair, are doing well. Consumable revenues, which are things like detergents and accessories, also grew by about 8.4%. And their capital equipment sales like sterilizers and surgical tables went up by 8.5%. It looks like customers are buying both the big ticket items and the ongoing supplies and services. Geographically, the United States remains their biggest market, pulling in $1.087.1 million in the quarter. Revenues from other foreign locations also showed strong growth, increasing by over 11%. Now let's talk about profits. Gross profit is what is left after you subtract the direct costs of making or providing the products and services. For the third quarter of 2025, gross profit was $655.5 million, up from $610.3 million the year before. That is a 7.4% increase. However, their gross profit percentage, which shows how much profit they make on each dollar of revenue, dipped slightly from 44.5% to 43.8%. The company says this is because while they benefited from higher prices and being more efficient, they were hit by things like tariffs and inflation, which drove up costs. For product sales, the gross profit percentage actually dropped a couple of points, while service revenue gross profit percentage nudged up a bit. This suggests that the costs associated with producing their physical products are becoming a larger part of the picture, even though the sales themselves are growing. For the 9-month period, the total gross profit percentage stayed almost the same at around 44.4%, showing they've managed to mostly keep costs in check over the longer term. Moving on to operating expenses, these are the costs of running the business beyond the direct cost of goods sold. Selling general and administrative expenses, or SG&A, went up by about 5% in the quarter and 5.5% for the 9-month period. The company attributes this mainly to higher costs for employee compensation and benefits. Their investment in the future research and development expenses also saw a modest increase, reflecting their commitment to innovation. Interestingly, restructuring expenses dropped dramatically. Last year, they had significant costs related to a restructuring plan that involved things like facility consolidations and position eliminations. This year, those costs are minimal, showing that phase is largely behind them. This is a good sign, as it means fewer one-time costs impacting their bottom line. All of this translated into a healthy increase in income from operations. For the quarter, it grew to $273.2 million from $245.3 million the prior year. Over the 9 months, it jumped from $650.5 million to $785.0 million. This growth is primarily attributed to the increased sales volume and pricing power they have, combined with lower restructuring costs. Looking at non-operating expenses, their interest expense decreased significantly. This is because they have paid down some of their debt. This is always a good thing, as it reduces the burden of interest payments. And finally, income tax expense increased, which is expected when profits go up. Their effective tax rate remained fairly stable around 24%. Now let's look at the cash flow. This is where the rubber meets the road on how much actual cash the company is generating. For the first 9 months of 2025, STERIS generated $1.006.0 million in cash from operating activities. That is a nice increase from $887.3 million in the same period in 2024. This boost in operating cash flow is mainly because they made more money overall. They also calculated something called free cash flow, which is what is left after they subtract their capital expenditures, the money spent on new equipment and facilities. Free cash flow was $737.6 million for the 9 months in 2025, up from $588.1 million in 2024. Higher earnings and slightly lower capital spending contributed to this increase. This indicates a stronger ability to fund their operations, pay dividends, and potentially invest in growth. Financing activities show how they are managing their debt and equity. Cash used in financing activities was significantly lower in 2025 at $470.3 million compared to a massive $94.3 million in 2024. This big difference is largely because in 2024 they likely used proceeds from selling off parts of their business to pay down debt. In 2025, their financing activities involved paying back some of their private placement notes and also continuing their share repurchase program. Speaking of share repurchases, they bought back about 0.2 million shares in the last quarter of 2025 for around $50 million. This is something many companies do to return value to shareholders by reducing the number of outstanding shares. Looking at the bottom line, net income attributable to shareholders was $192.9 million for the 3 months ending the 31st of December 2025. This is up from $173.5 million in the same period last year. And for the 9-month period, net income was $562.1 million compared to $469.0 million in 2024. This shows a solid increase in profitability. Now let's touch on their business segments. They report in 3 main areas: healthcare, Aston Life Sciences. Importantly, the dental segment, which was previously reported separately, is now presented as discontinued operations due to its sale in May 2024. This is common practice when a company divests a major part of its business. The company also emphasized their organic growth, which essentially means growth from their existing businesses, excluding the impact of acquisitions and divestitures. This is a key metric for understanding the underlying health of the core operations. For example, their healthcare segment saw organic revenue growth of 9.0% in the quarter on a constant currency basis. Looking at the balance sheet, their assets grew from $10.46.8 billion at the end of March 2025 to $10.591.4 billion at the end of December 2025. A big chunk of this is goodwill, which represents the premium paid for past acquisitions. Intangible assets also significant accounting for their patents and brand value. On the other side, their liabilities decreased slightly overall. Long-term debt is around $1.898.4 billion. Shareholders' equity, however, increased nicely, reflecting the growth in retained earnings from their profits. It is also important to note that STERIS faces various legal proceedings and claims. They have a specifically noted a significant settlement related to ethylene oxide or EO litigation for up to $48.2 million. This is a reminder of the risks inherent in operating in certain industries. They believe the ultimate outcome of current lawsuits will not materially impact their overall financial position. In terms of financial instruments, they use forward contracts and swap contracts to manage currency and commodity price risks. These are not used for speculation, but rather to hedge against potential losses. Notably, they held contracts for euros, Australian dollars, and New Zealand dollars. They also have defined benefit pension plans and foreign currency translation adjustments, which affect their accumulated other comprehensive loss. The good news here is that their accumulated other comprehensive loss significantly improved in the most recent periods, indicating a better financial position related to these items compared to the previous year. So now for my take on STERIS. On the surface, this report looks pretty positive. Revenues are growing, profits are up, cash flow is strong, and debt levels are manageable. Their ability to grow organically across all segments is a great sign of a healthy core business. The reduction in restructuring charges is also a relief. However, there are a few things to keep an eye on. The slight dip in gross profit percentage for the quarter due to tariffs and inflation highlights the ongoing challenges of rising costs in the global supply chain. While they seem to be managing it for now, it is something to watch closely. Also, their significant goodwill balance means a lot of their value is tied to past acquisitions, so successful integration and continued performance of those acquired businesses are crucial. The ethylene oxide litigation settlement, while seemingly managed, is a reminder of the potential for unforeseen legal risks. Overall, STERIS appears to be navigating a complex economic environment effectively. Their focus on infection prevention and healthcare solutions is a strong market position. The company seems to be on a solid growth trajectory driven by its diverse product and service offerings and strategic acquisitions. That is our breakdown of STERIS PLC's latest financial report. What is your take on these numbers and what do they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.